Liam sat down on a Tuesday afternoon to check his bank balance the way he always did. 69 years old, careful with money his whole life. Bills paid on time. A cushion in his checking account. 2 years earlier, he'd added his son to that account so someone could help him out when his arthritis made trips to the bank harder. Everything looked normal until the morning $44,000 was gone. Not stolen by a hacker, not taken by a stranger, withdrawn legally by the person whose name was right there on the account. When Liam called the bank, they told him there was nothing they could do. He'd signed an agreement that gave his son every right to take it. Liam isn't rare. This happens to families across the country every single year, and almost nobody finds out until it's already too late. If you share a bank account with anyone, a spouse, a parent, an adult child, a sibling, there are 3 things about that account that have quietly changed. No letters, no warnings. Most people never find out until the money's gone. Stick with me, because by the end of this video, you'll know exactly what to check this week. Here's why your bank will never bring this up. A joint account means more money sitting insured, more transactions, more fees, no matter who touches it. The bank has zero incentive to explain what equal ownership really means, and right now, that gap in understanding is costing families real money. The numbers back this up. Financial exploitation tied to shared accounts costs Americans $28 billion a year. 70% of it comes from someone the victim already trusted. In one recent year, 88,000 documented victims lost an average of $35,000 each. Not strangers online, people already on the account. So let's start with the part almost nobody understands. The mistake hiding in plain sight. When you add someone to your account, you're not adding a helper. You're not adding an authorized user. You're creating a co-owner. The second both signatures are on that form, the other person owns the entire balance. Not half, all of it. Banks call this convenience. If something happens to you, they say, your loved one can step in right away. What they don't say is that this convenience comes with legal consequences that don't pause for grief, emergencies, or good intentions. Here's the pattern that repeats again and again. A parent adds an adult child to help pay bills. The parent thinks of it as help. The bank never says otherwise. But legally, that parent just handed over ownership. And that one detail is what makes the next 3 changes so dangerous. Change. Number 1, your will may not matter anymore. Most joint accounts carry something called right of survivorship. When one owner dies, the other gets the full balance instantly. No probate, no delay. That part isn't new. What's changed is how banks are enforcing it, and how final that enforcement now is. Picture this. 3 adult children, a will that splits everything evenly, but only one child is on the joint account. When the parent passes, that one child gets 100%. The other 2 get nothing, and they have no legal recourse. The will says one thing, the account agreement says another, the account wins every time. The Consumer Financial Protection Bureau has flagged this as a growing source of family disputes. And here's the part that should worry you. Many people signed their account agreement years ago. Banks quietly update these agreements over time, usually through a notice buried in a mailing nobody opens. You never signed the new version. You're still bound by it. That's rule 1. Now here's the one that doesn't even require anyone to die. Change number 2. Someone else's debt can drain your account. Take Patricia, 67, a retired nurse from Knoxville. After her husband passed, her son suggested he be added to her checking account to help manage her bills. Patricia's pension, her Social Security, 3 decades of savings, all sitting in that account. Then her son's business partnership fell apart. A creditor won a judgment against him, and that creditor reached straight into Patricia's account and garnished $44,000. She'd done nothing wrong. But under joint ownership law, her son's creditor had the same legal claim to that money as they did to his own. It took 8 months to fight it. She got some of it back. Not all. The IRS works the same way. Under federal law, they can levy a joint account to collect one co-owner's tax debt. Civil judgments, federal tax liens, even student loan collectors in some states, all of them can reach a joint account. And there's a quieter danger hiding here too. Medicaid. If you or your spouse ever apply for long-term care coverage, the government reviews your finances going back 5 years. A joint account can complicate that review significantly, even if only one person ever put money into it. Families who never thought twice about adding a child to an account sometimes find themselves facing delays or penalties at the exact moment they need help most. Right now, not later, right now, pull up your bank's account summary, look at every name on every joint account you hold, then ask yourself, do you actually know what debts that person is carrying? Your answer tells you how exposed you really are. That was rule 2. The third one is the reason I made this video. Change number 3. The window scammers are waiting for. A co-owner has full legal access to your account, by definition. So when unusual withdrawals start happening, the bank's fraud system doesn't flag it the way it would flag an outside thief. The transaction looks authorized. Because technically, it is. Older account agreements let you dispute unauthorized withdrawals and trigger a review within 10 business days. Updated agreements have pushed that window out to 90 days or more, sometimes longer. In some documented cases, banks have refused to resolve the dispute at all because the co-owner had legal access. Here's where it gets personal. Picture a husband and wife sharing an account the way they have for 40 years. One of them starts showing early signs of memory loss. Around that same time, a call comes in. Someone claiming to be from the bank's fraud department, warning that the account's been compromised, saying funds need to move to a safe account right now. The spouse with memory trouble, wanting to do the right thing, follows the instructions. Because it's a joint account, the other spouse legally owned that money too, but had no idea the call was even happening. Scam callers are using more convincing tools than ever, including technology that can imitate familiar voices. Combine that with a longer dispute window, and you get the highest risk moment for joint account holders in a generation. 3 rules, all quietly changed. None of them required your signature. So here's what to actually do about it. 5 steps starting this week. Step 1. Get your current account agreement. Call your bank and ask for the current joint account agreement, not the one you originally signed. Read the survivorship clause specifically. Step 2. Compare it to your will. Bring both to an estate attorney or your state's legal aid office. Many people discover the conflict for the very first time in this conversation. Step 3. Ask about a durable power of attorney instead. This lets a trusted person handle your banking and step in during an emergency without transferring ownership. Your money stays legally yours, protected from their creditors, and passes according to your will. Many banks also offer a payable-on-death designation. Your beneficiary gets the funds quickly after you pass, with 0 access while you're alive. Step 4. Set up a buffer account. Keep a modest amount, 30 to 60 days of expenses, in a joint account for real convenience. Keep your primary savings in an individual account with a transfer-on-death beneficiary. Access stays available. Your real savings stay protected. Step 5. Check your state's garnishment exemption rules. Search your state's name plus joint account garnishment exemption on your Attorney General's website. Some states protect Social Security or pension funds even inside a joint account. This step costs nothing, and almost nobody takes it. Ask your bank if they offer a trusted contact option too, someone they can call if they spot unusual activity. It doesn't give that person access to a dime. It just adds one more set of eyes. But here's the habit that catches what every safeguard misses. Check your statement every single month, not once a quarter. A family member pulling small amounts regularly rarely triggers a fraud alert. Nothing about it looks unusual to a computer. You're the only one who knows what should be coming in and going out. That one habit, 5 minutes a month, is the safety net nothing else replaces. The account you opened for convenience isn't the same account today. The survivorship clause can override your will. A co-owner's creditors can reach your balance, and the window for stopping exploitation has gotten wider, not narrower. None of it needed your signature. None of it came with a warning you were likely to read. Take these 5 steps this week before something else decides the timing for you.